Okay, so here's a question for you guys. The topic of my presentation today is tips for avoiding trade traps. So how many of you have felt like you've been particularly unlucky in a lot of your trades, or even just some of your trades? You know, where you enter a position only to have it turn against you almost right away, or you find that you're flushed out of a position and it turns around pretty quickly and goes in the direction that you thought it was going to in the first place. How many times does that happen to you? I know it's something that for me has been particularly frustrating over the years, especially, you know, when I was first getting started in the markets. You know, I started trading back in the mid 1990s. That's when I got my feet wet. And by getting my feet wet, I mean that I jumped in feet first, not really knowing how to swim, but I got lucky enough that I could at least tread water. So from there, I learned a lot of things. You know, there wasn't a lot of education back then as far as online trading goes. You know, there were basics like buy 3 to 5 bar pullbacks into moving average support, things like that. But there wasn't a lot of information on the details of market analysis and trade analysis. And the thing I want to teach you guys today is that there are a few key principles you can learn about the market and technical analysis that you can take away from my presentation and start applying to your trading right away. So I want you to pay attention and watch for those key tips that I put today and write them down. And you know, they have a recording for today's session. So as soon as you get that recording, it's a great idea to go back and review it because you'll pick up a lot of things that you might have missed the first time around. So today, I want to help focus on stopping any chance you have for being the victim of these false trade triggers and market whiplash. Now, the main way you can avoid things like a false trigger or whiplash is to understand the circumstances that can create them in the first place. A lot of traders will get into positions on typical setups like a trading range break, a channel break, trading channel break. That's probably one of the first setups most of you guys are ever taught or ever learn or come across online. And basically, it's just a breakout coming out of a trading range. And oftentimes, these are very typical zones where traders fall into these trap positions. They'll place a stop. Let's say you're looking at a breakout to the upside. They'll place a stop underneath that trading range and get into the position as soon as the upper end of that trading range breaks. Well, oftentimes they'll be in a situation where the range will, where your trades will pull back into that trading range, flush out under the range, trigger the stop, and then turn around and go and do exactly what you were expecting in the first place. Or they'll take what looks like a perfect trading range breakout to the upside, but it won't get anywhere. It'll go up for just a little bit, look like it's going stellar, exactly like you would expect, and then it turns around and whips the other direction very, very quickly. So we're going to look at some of those circumstances today, and I'm going to show you actual trades that I've had and that I've discussed in my previous live mentoring and previous sessions such as this, because I really like to show you guys things that are happening and things that I've talked about live where you're not dealing with like this is 50-50 hindsight. I want to show you things that we've looked at that I've discussed with traders real time as they were unfolding. So when I give presentations, a lot of times what you'll see is things that I discussed during one presentation. I'll use those and pull them into the next one because it'll show you the follow through of things that I discussed in the previous one. So what you're going to see is that this particular topic is not designated for one particular market. You might be a futures trader, you might be a stock trader, you might trade bonds. It doesn't matter. The strategies that I'm going to teach you and that we're going to focus on are going to be ones where it's going to apply to no matter what market or what time frame you trade. So let's get into the presentation slides here. And all of the charts here in this particular class are done using TradeStation. So first of all, understanding a trap. A trap occurs when you take a trade based upon a typical entry trigger, such as a breakout, only to have the position reverse quickly against you. And this will often trigger a stop or flush you out of a position. Now, there are so many things to learn in the markets. As Anka mentioned, it takes a long time to really become highly proficient at understanding the market. I've worked with traders everywhere from individual traders to some of the institutional traders, market makers, money managers. I've worked with all of them over the years. And there's always a learning curve with anything in the markets, but what I found is that there are ways that you can help other traders shorten that learning curve. A lot of times it takes them going back and re-listening to a lot of the classes that I've given, a lot of the lessons. I've worked individually with traders in understanding, their own trade dynamics. And so if you can go back and just kind of put everything on repeat, it's going to start to sink in. And the great thing about my style of technical analysis and market analysis is that once you get it, you have it. So if you have to step away from the market for whatever reason, like a couple of years ago, I got sick. I had to take a medical leave. And when I came back, I was a little bit rusty, but it's like basically jumping back on a bike and riding your bike again. You might be a little wobbly at first, but it often has more to do with just not being quite as in sync with the market from not following it every day. But everything that you knew before is still there. All of the tools, all the techniques still work. So I want to teach you today some of the very practical tools and techniques that you can apply to whatever market it is that you trade. So today, there's 3 things that we're going to look at. And these are things that you have to know, you have to have an understanding of in order to avoid the traps, or not only just avoid the traps, but understand when a trap is possible, so that if you still like the longer term outlook potential on a position, but you know that a trap is possible, you can adjust how you take that trade based upon that knowledge and based upon that understanding. So when I talk about avoiding traps, there's a couple of levels of avoidance, and it tends to depend upon what your comfort level is in the market and what your experience level is in the market. So for a newer trader, for example, I would focus on purely avoiding traps so that you're not going to get into as many of them in the first place. And then later on, as you progress and you learn more and more about the market, I'd move on to how to understand how those traps form and develop, and how you can get in before a trap might happen, but you can ride out the trap by understanding its development. So there's a couple of levels of knowledge there, but there's 3 things that you have to learn, and those are trend development, time development, which you might not have heard of before, and momentum, which is another one of those things that when I first started teaching, traders weren't really focused upon, but all of these are really important. So here's your typical trend development, blah, blah, blah. You guys have probably seen some version of this a million times, especially if you've been trading for a while. Typical trend development, as they teach you in pretty much every online site available out there, is that you're looking for 3 waves of upside, and then usually a trend is exhausted. Obviously, it's not as simple as that. There's going to be many exceptions to how to understand this, but I want you guys to focus on the basics here. And then we're going to get into some of the nuances. And the basics are, when you think about trend development in the market, think in terms of 2s and 3s. So you're going to be looking at 2 waves and 3 waves. For example, when we look at this basic image here, we've got 3 waves of upside and then a break in the trend channel. And we have 2 waves of correction between each of those 3 waves of upside. Now, you can also see situations where each of these upside waves might have 2 waves within them. And let me turn on a highlighter here so you guys can see that. So they might have 2 waves like this, or they could even have 3 waves. So there's a couple of ways that this can happen where you will have these types of development, of trend development. And this is just your very basic, straightforward type of trend. Now, when we look at time development, what we're looking at is this period of time that occurs within a trend itself. And this is one of those things that is really overlooked a lot by traders. They'll be counting the waves up, the waves down, but they don't pay as much attention to what happens between those waves and the activity that is developing between those. So when we look at time development, we're looking at a couple of things. We're looking at how long it takes a corrective move to form. For example, this might be 30 minutes here. So when you're counting waves for a trend on the upside, what you want to see is a secondary correction that is comparable to the first correction. Meaning if this one is 30 minutes, you want this one to be somewhere between 25 and 35 in order to say that this third wave on the upside is really showing greater signs of exhaustion. If these are different, dramatically so, then you might not be looking at 3 waves of trend development. You might be looking at different waves within a bigger trend on a larger time frame. So you have to pay attention to that time development when you're looking at trend development. Now, another aspect of time development here is to look at the waves themselves. Now, when you have these primary moves within a trend, each of these moves is called an impulse move. Many of you are probably familiar by now with the concept of measured moves or equal moves. It's a technique that people watch for when you're looking for trading breakouts, where you have an initial upside move, and let me change the color so you can see this a little bit better here, where you'll have an upside move, a trading channel, and then a breakout, and you'll be looking for target levels where this breakout, let's label it B, is comparable to the first move on the upside, which is labeled A. So this breakout here, for example, you'd be looking for a measured move that was similar to 1. Well, the thing here is that with these movements, with these impulse moves on the upside, that technique works extremely well if, and here's the catch, if momentum is the same on each of those moves. So for example, momentum is how fast an impulse move or any other move in the market shifts. It's a change that happens within the impulse moves. So when you're looking at the impulse move on the upside here, ahead of A, and you look at this trading channel in A, well, the breakout is pretty comparable in terms of how fast and over how much time it takes to develop. And so that would give you an equal move target up there. But when momentum shifts and changes, that can change target levels and that can change your expectations on a breakout as well. It can make it more difficult to hit those measured move type of targets. So in D, for example, we have a slower move coming out of there. So it's less likely to hit those measured move targets. And so these are the concepts that we need to pay attention to when we are looking at our trades. Now, here is an example of some really typical ways that a trend can develop. But you'll notice it's not as pretty as that textbook trend that I drew for you guys, because real trading isn't always that pretty. And if you wait and look for all of those perfect trades, you're going to miss so many trades. What you need to pay attention to are those concepts where we are looking at counting each of the moves. So when we look at this downside off of the high, for example, you want to start counting the corrective moves. If you have an initial pop to the upside and you're trying to look for a short, you need to be aware that there is a good possibility that you will see a second attempt to pull higher or base within that correction as well. It might be that you have two waves within this little pop, or it could be something like this, where it pulls, puts in a slightly lower low, and then pulls back up into this range. And this is where a lot of traders can end up with trap situations, because they will get short on this bounce, this initial bounce, or they'll try to take a break under the low here. And then they might keep their stop too tight. So when it pops back up, maybe they moved it to break even and they end up getting flushed out. But if you are aware that there is a strong possibility for a second wave to happen before you could get another break to the downside, it prepares you. It means that you can be more cautious about trying to move stops to a break-even level. You could look for tighter gains if you're just looking for scalping or just looking to take advantage of an initial move to the downside like here. And it can keep you from moving your stops too quickly. It can also give you an opportunity to build into a position. So if you really like a reversal that is forming or a breakdown that is forming, and you see this second bounce happen, and you've already entered in with a smaller position, you can add to the position on that second bounce. So here you can see that we have that two-wave correction like we saw down here. It's just, it doesn't look quite the same. It's a little bit different. It's another variation. And over time, you'll start to pick up on these variations. The more you can go back and review your trades looking for these, the easier it's going to be to start to identify them as they're happening. In fact, you have the same thing happening over here, where it had that drop to the downside, correction, pop to a slightly lower low, which again could easily trap shorters on the downside, pop back up, and it's not even that uncommon that this might pull up and take out that previous high. So somebody could get flushed out of the trade very easily right there. But if you look at things like looking at the time development, and you look at how long previous levels of correction have taken, it can cue you in to the fact that you might just be a little bit too early on the short side. It might need more time to base out in order to get a stronger move on the downside. So if you are looking at this on a breakdown, you take it a little bit early, you had a stop above here, even going into the position, I would be aware of the fact that that stop could get hit pretty easily. So I would be more likely to take a smaller position to start with to allow for that to possibly pull back up into this congestion up here, up at this high before it tried to move to a break to the downside. So understanding that corrections often take two waves and sometimes three, just as a trend can, that can help prepare you to avoid some of the traps or be able to manage them as they're forming. Here's another example, a little bit of an early breakdown here, popped back up into the range. Oftentimes, when you're trying to catch an initial breakdown, especially one that breaks a little bit early, it might go too fast for you to get a decent price on it. Usually I'll use multiple time frames where I'm dropping down to a smaller time frame to try to get into it at a better price. But I also do a lot of what Anka mentioned in her presentation, where I'm relying on price levels. And when this pulls back up into that trading range, because the overall pattern has formed, and now at this point in time, you have a time development that is very comparable to the one that formed after the first drop. That serves as a great spot to build into a position or add to a position or take a new position as it bounces. So you can look for these trend developments, and even if they start to look a little bit tricky, the general idea is that you will still have three waves and two waves constantly forming. So let's go ahead and move on to the next slide here. And if you guys can't see my pointer at any time, just let me know. So here we're going to look at, this was actually a breakaway gap trade from a few months ago, was one I worked on with a live class back then as well. We were looking at the development of how to enter these breakaway gaps and the management of these type of gap patterns. Well, with this particular trade, you'll notice that this had a series of breakouts after the initial gap trigger. The gap trigger came pretty early in the morning on the 21st, where we had a breakout to highs and there was some intraday action, and it had several continuation type of moves. This is another one of those trickier trends that developed, and it can help you identify breakouts that might not be as strong as another breakout. Usually a breakout that happens between the first and second wave of upside is going to be your most ideal breakout because you're usually early in a trend. You can even build into positions or hold on to some of your position longer term to look for an even larger move like we did here on CAI. But when trend starts to get more extended, then you start to run into risk that it's not going to work out very well for you. So for example, here we have a typical type of trend development that's forming, but it's also a reversal pattern that I refer to as a momentum reversal. And this goes back to our discussion on momentum, where when we're looking at trend development, momentum development is extremely important. If you have momentum that is starting to shift, where you have strong upside on the first wave within a trend, but your second wave starts to slow and it's not as strong as the first wave, chances are higher that your third wave can be even slower. So if you're looking at taking these breakouts, let's say you missed this one here on the 24th, and you're thinking, okay, I'd still like, another breakout. This is looking pretty good over here. It pulled back gently, it popped, it based here. So you might be thinking, oh, hey, I'm going to take that as a breakout. Well, because your momentum is starting to shift here and you're even getting some slightly higher highs, your risk is going to be higher that could serve as a possible trap. Another thing that was happening on CAI at this time is when we talked about impulse moves, CAI had an impulse move on the larger daily and weekly time frame where this breakout from the gap had a move where by the time it got up here, it was already nearing that measured move. So not only just on the 20-minute time frame did we start to have some problems developing for the bulls, but we also had resistance that was starting to show on the larger time frame where the impulse move was hitting that equal wave type of resistance. So it was showing trend exhaustion on the larger time frames as well. Now, one thing that I want you guys to see here as well is that many of these upside moves also have typical trend type of development where we had two waves of upside within each of these larger waves. So the concept of 2 and 3 basically applies to any time frame. And when you have 3 to the upside, if you get an attempt at a fourth one where you had comparable periods of time development, where the time between 1 and 2 and 3 is very similar, and then you end up with a similar time development between 3 and going into what could be 4, well, you're looking at something that is very likely to be a trap. It's going to have a very hard time getting going. Now, if this is happening on a daily time frame, yeah, you might still have a trade in there. It might still be worth it. If this is happening on a 5-minute time frame, you're more likely to get stuck because what goes up like that on the fourth wave can go back down very, very quickly. So understanding that trend development as well as the momentum shifting is very important. And many times this is something that I will use as a reversal trade. I call it a 2T, which is a double top 2T two tops, easy enough to think of. When it forms at a bottom, I call it a 2B or two bottoms. And basically, it's a trap in and of itself, where it is trapping people that are buying above these previous highs and buying this fourth attempt at a breakout here for a fourth wave, and it reverses, and it's usually a pretty strong reversal. So let's look at how this ended up following through. This is the image that I caught during the class, and you can see that after class was over, it went and it reversed pretty well. It had some strong movement on the downside and continued to correct for quite a while before it was able to bounce again. So usually this type of shifting momentum, along with that trend development, is something that is ripe for traps for the bulls. And here's another example for you. This is one that I tweeted about a while ago, where I was looking at the market to reverse or correct. And it also shows another tricky type of trend that a lot of traders will miss. They'll misread it. So let's look at that. It started with an upside move down here, marked 1. This is the first impulse move of what began a new trend on the upside. And basically, it began with a V bottom, where momentum was pretty similar on the downside as it was on the upside. That's fairly common. You get V bottoms, you get V tops. But then it didn't go into a sideways trading range like that typical trend that I showed you. Instead, it shifted momentum. So when you have a new trend early on that does this, you can have two things that can happen. It can treat this entire momentum shift the same way it would treat a bull flag or any type of base, where it's basically taking time to correct. Even though it's hitting higher highs, it is still a corrective type of phase. It is correcting from this initial rally here. Now, if within this correction, the momentum shifts where you have stronger downside moves and slower upside moves, then that can tell you that you're actually looking for more of a reversal type of trade, that the momentum is shifting for breakdown like we saw on CAI. On the other hand, if the momentum is still remaining pretty strong, like we saw in here with some nice pops on the upside, then basically you're more looking at this being a corrective move, and you have to think of it as a corrective move. So this is a situation where sometimes maybe people get trapped on the downside because they're thinking, oh, hey, it's coming into a closure of the gap. It's filled the gap level. It's at resistance. I'm going to look to short it. But in reality, it's something that is gearing up for another breakout on the upside. Now within this, you'll notice that it still had those two wave of corrections, and you can see that a little more clearly by counting the lows. There's one low and then there's two lows, so that can make it easier to discern, has it had these two periods of correction. Even if you can't count the highs as easily, you can usually count the lows. Those tend to stick out a little bit better within these type of corrections. Now up here, we had more of a little bit of a closer to a traditional type of rest, where it had an initial pullback, a secondary pullback, but you'll notice right here that it gapped up, and that could have triggered a trap. Why was it too early to offer a strong break on the upside? Well, when you look at how long the first break took, where the momentum was shifting and slower, that took 4 days to develop. So when this tried to break higher, it had only rested for just over 2 days, meaning it was still early for a breakout. So it was more prone to creating a trap when it broke higher. Now, granted, in this case, it gapped to the upside and pulled right down pretty quickly. But if you had gotten trapped in it, a lot of traders would have used under this previous low here as a stop. And so not only could they have gotten trapped on the upside with the gap, thinking, oh, this is another breakout on the upside, but you would have gotten flushed out on the lows with a low under that stop because you would have thought, oh, hey, now it's failed. When in reality, it just needed more time before it could get going. So if you are understanding time development, it can help you avoid these trades in the first place. And if you get more advanced, it can help you manage them a little bit better. Because sometimes it's okay to get into a breakout a little bit early if everything else is still in its favor, but it's something where you have to have more knowledge to manage it. For example, you might get into a breakout over here, and it might be a little bit too early, but you're still in it at a much better price than if you waited up here for when the channel would start to break. So there are reasons that you want to get into some trades earlier, but you have to understand that these are situations where traps and flushes like this are going to be more common. So here we had this upside move happening on the Qs, and heading into this action here, looking at this move here, I issued a warning to watch for a market correction at that point. And we had a couple of things in play. First, we had the trend exhaustion, where we had 1, 2, 3 waves of upside. And we also had a point where we were looking at 4 days of development here and some attempts at some slightly higher highs, creating, once again, the same type of traps that were happening over here. But because the trend was now more extended, these traps really became very, very strong traps. Now, this did end up having some help with it. Amazon put out some news the next day, but it was already in development before that news was ever on the radar. So what happens is that a lot of times news propels these technical triggers, these technical strategies that are already forming. And news can just amplify them, and it can make them go even stronger than they would have in the first place. With this trap, though, what we had happening is that if you look at, the lows and the highs within here, we had a channel where the momentum was really starting to shift already. Before any of this news came out, you had momentum shifting. So it created essentially that same type of idea as that 2T that I talked about, where you have a slightly higher high that actually looks to create a reversal strategy. So all of these things work together to create that breakdown there. Now we're going to go look at a couple of other types of things where you can get flushed out. I'll clear this here. Okay, this was another trade that we took based upon a gap trade. This was another gap trade that we discussed. And this one didn't trigger a trap, but I want to show it to you because it shows when traps are very, very common. So this is going to be one of those tips to write down. And that is when you are looking for a breakout type of strategy. And here you can even see these, 2 waves of trend development, 2 down, 2 basing. When you're looking for these breakdowns, you can enter into a position as it's forming this really narrow, tight range here in anticipation of the breakdown. But if you miss the breakdown, oftentimes, if this range is super, super narrow, like we see here on MOMO, it will usually pop back up into that range and even can take out the high of that range before it breaks lower. So often I will use that pop to initiate my position where I am shorting it as it's bouncing into resistance. And that allows me to not only be able to place a better stop above the highs of that bounce, but also I don't risk those flushes that happen. However, if I'm building into a position before that break happens, or I take it as the break happens, where my entry is under that trading range, knowing that extremely narrow bases which occur before a break happens will often have a pop back up into it, means that I will keep my stop wider. Whereas a traditional breakdown, you might have a stop above the highs of the last part of that trading channel. If it's a situation where the range is super narrow and volume is super light, I'm going to keep a wider stop to make sure that I'm not going to have as much of a chance of getting flushed out when that thing bounces. And you know, as this unfolds here, it has the typical unfolding of the trend action. Here it had two waves of downside, momentum shifted on the breakdown, which allowed for the time development to actually be wider here than it was over here for the first two moves. But you still have that two-wave follow through as well. Two waves within here before it triggered a continuation. And then here, you got that momentum reversal forming again, where you got three moves, 1, 2, 3, 1, 2, 3 lows, and it helps trigger a reversal pattern because your momentum is shifting. So everything flows and works one part of the trend into another part of the trend. And once you start to understand not just the 2s and 3s for trends development, but you start to understand the time development and momentum, then you can start to predict not only what the next move will be in a breakout or any sort of trade that triggers, but you can even understand what the most common follow-through trades are going to be. So not only can you understand that first initial move when it first breaks down, but by learning these things, you'll understand how to figure on secondary and tertiary moves as well. Here's another example, CAL. Again, you can tell I was dealing with breakaway gaps in my last classes because we were looking at CAL as an upside breakout. And this has a couple of strategies on here that are very common that a lot of traders will take. This was a breakaway gap on a daily time frame, had room on the upside for more upside. So it came down to, okay, so how do I get into this position? You know, what kind of trade do I take to take this position? And with that, it can get a little bit tricky. So CAL was a little bit thinner to start with, and that can make things a little trickier, but also it gapped up but started to fill in the gap. So a lot of traders, what you'll do is you'll look for things like a cup with handle. So here is your first cup with handle. Understanding the two-wave development though, with corrections and especially something that might be in a trading range, it serves to know that this move off of the lows of the cup and into the handle is your first wave of upside. So you can have a second wave of upside, but if this entire move here is slower to the upside than that initial downside was, then this is probably more of a corrective type of move. So then you're at risk of there being a second pullback or second move to the downside. And that can take out the lows of that first drop. If you are looking at this and you end up entering part of your position with the cup with handle, you can still take a decent trade and keep proper risk by looking at this first initial move to the downside, taking your entry zone and figuring on if this breaks to the downside, a measured move is going to be around 25.50. So instead of keeping a stop here or a stop here, my stop would actually be under where that measured move would be. And that's going to keep me in the position longer term. Granted, this means that my share size is going to be smaller, my position size is smaller, but I'm not going to be at much of a risk of getting flushed out of the position when that happens. So if this were to break under that low, then I wouldn't really be panicking at that point. I'd just still be sitting it out and waiting, knowing that this still may need a little bit more time to develop before it could break to the upside. So when it goes and puts in that secondary move, that secondary pullback now, 1 and 2, at that point, when that channel breaks to the upside, that's when you can go ahead and adjust your stop, and you can move your stop up if you got into part of the position here, and you can build into the position now. So you can take more of the position and move your stop up, or if you were a more conservative trader, that's where you would start to initiate the position in the first place. So there's a couple of ways you can trade these trades, and no two traders are the same. This is why I do a lot of work with individual traders, because everybody's personality is a little bit different. You know, everybody's risk levels and comfort levels is a little bit different. So a lot of teachers, a lot of mentors will say, okay, you're looking for 2-to-1 on a trade, or you're looking for 3-to-1 on a trade, or 1-to-1. Well, you know, they're traders that they're talking to. Each of those traders might not be able to do those 2-to-1, 3-to-1. They might only be looking for 1-to-1 and do well with 1-to-1. Or if they're giving trades that are 1-to-1 and, you know, that's awesome for them, it might not work as well for somebody else. So understanding, you know, trend development, time development, the momentum, even, you know, the key periods of time during a day when reversals and breakouts are most common. Once you start to really merge, you know, really immerse yourself in that knowledge, you can start to develop your own system that works best for you. And, you know, I do a lot of live trading, a lot of live mentoring with people where we're following the market as it's progressing and looking at these different risk factors as they unfold in the day. So you can see, you know, I like to interact with my traders too. I like to say, okay, so-and-so, here's what's happening now. What do you think is going to happen next? And what this does is it forces people out of the comfort zones, for one thing, because you're kind of on the spot there, but it makes them also, you know, speak out loud what their thoughts are as to what levels are going to serve as major, you know, major places of, you know, support, resistance, development, and whatnot. I think I'm running a little short on time here, so let's get into what's next. And obviously that includes more education. You know, looking at a lot of these things in different light, you know, understanding, even here, look at the, you know, the image on here, 3 signs of trend exhaustion. You can see that we have momentum shifting here. So I have a course that I put together for you guys that's called 3 signs of trend exhaustion. And this can help you not only avoid these traps, understand the traps, but even trade the traps, where you can trade the reversals on these traps. So if you want to keep learning, and I'm assuming since you're all here that you do, go check out this 3 signs of trend exhaustion. You can get it right now for $39 for this weekend here. Go pick it up today. It's tonihansen.com /July 15th. So you have a really simple to follow URL. And if you have any questions for me at all, I'm going to throw my email address in here for you. And you can reach me at info@tradingfrommainstreet.com. So I'm going to send this all to you guys in the chat box. So if you have any questions on, you know, today's presentation, anything at all, one question here is, you know, do you have a live trading room? I actually ran a live trading room for more than a dozen years. I got kind of burnt out because I was there all day and half the night, half the time. So what I do now is I set up sessions where I will do a live mentoring. So like for 1 month, we will meet for so many hours every, you know, certain days of the week. And we follow the trades, we follow the markets, and I teach throughout that time. So it's not just, okay, here's what I'm taking. You know, trade this, trade that, trade this. But we're looking at the market and how to understand the market so that you can trade it. So if that's something that you're interested in, shoot me an email. I'm getting one put together for the end of the summer here. So I'll be doing the next one probably, I think it will start in September. Usually when I get going with those, I have them every month, but with the summers, it's been a little bit crazy. So that will be starting again here in another month or so. So if that's something you're interested in, email me, info@tradingfrommainstreet.com, and I will turn this over. Thank you guys so much for having me today, and I hope that you enjoyed today's class and got a lot of information that you can go out and apply to your trading this week.